Good morning, everyone. My name is Connor Berry, and today I'm delighted to present a comprehensive and personalised approach to managing your inheritance of £100,000. The objective is to align your investment strategy closely with your individual financial goals, your comfort with risk, and your long term aspirations, ensuring you achieve maximum value for your inheritance. Throughout this presentation, we'll examine three clearly defined investment strategies tailored to varying levels of risk: high risk, moderate risk, and risk averse. We will discuss various personal and economic factors crucial to the investment decision, conduct an in-depth analysis of each investment sector, outline important tax implications, introduce the efficient markets hypothesis, and finally present expected returns along with personalised recommendations. Strategy number 1, risk averse. This strategy sees us placing 10% of the money into cash, 35% into commercial property, 45% into bonds and gilts, and 10% into equities. This strategy prioritizes stability, minimizing risk with a significant allocation towards bonds and commercial property. This strategy is particularly suitable for individuals nearing retirement or those with low risk tolerance. Our second strategy is the moderate risk strategy, seeing us place 10% into cash, 29% into commercial property, 37% into bonds and gilts, and 24% into equities. This strategy provides us with balanced growth and sustainability, combining bonds, equities, and property investments to provide steady returns with moderate volatility, ideal for investors seeking growth without substantial risk exposure. Our third and final strategy is the high risk strategy, which allocates 5% to cash, 24% to commercial property, 33% to bonds and gilts, and 38% in equities. This strategy targets aggressive growth primarily through equities. This strategy accepts greater volatility in exchange for potentially higher long-term returns, suitable for younger investors or those comfortable with market fluctuations. So which option is best for you? Investment decisions should always reflect personal and economic circumstances, including age and health. Younger, healthier investors typically have longer investment horizons and can afford greater risk. Conversely, older investors may favor security and income generation. Family and marital status. Investors with dependents or significant family commitments often prefer safer investments to ensure financial security for their families. Job security. Strong employment stability permits a higher risk tolerance, while uncertainty typically leads to a more conservative investment choice. Current pension status. Investors with substantial pension arrangements can confidently explore higher risk investments, whereas those with minimal pension coverage should prioritize security. Professional ambition. Ambitious career plans or business goals may dictate the need for liquidity and flexibility, influencing asset allocation significantly. Breaking down the four investment sectors. Cash investments provide immediate access and unparalleled liquidity, making them ideal for meeting short-term financial goals and emergency situations. They also offer guaranteed returns, albeit typically modest. However, the most notable downside is inflation risk, as the purchasing power of cash investments may decline if interest earned does not keep pace with rising prices. Bonds and gilts, especially those issued by stable governments and reputable corporations, offer predictable and reliable income through fixed interest payments. They add stability to investment portfolios, especially during volatile market conditions. However, their major disadvantages include inflation risk, which could diminish real returns, and credit risk, the possibility that an issuer could default on their payments. Properties and REITs. Property investments, including real estate investment trusts, present opportunities for significant capital growth and regular income through rental yields. Property assets are also recognized as efficient inflation hedges. However, the drawbacks of property investments include relatively poor liquidity, meaning they cannot be converted quickly into cash, and high initial costs, including legal fees, taxes, and maintenance, potentially restricting the portfolio flexibility. Equities are typically attractive due to their significant potential for capital appreciation and dividend income, and their ease of trading often offers excellent liquidity. They are especially appealing to investors seeking high returns. Nevertheless, equities are associated with the highest levels of volatility and risk, as market fluctuations can rapidly alter asset values. Investors may also consider potential tax liabilities arising from capital gains and dividends. Speaking of tax implications, understanding tax implications is vital to maximizing investment returns. Cash ISAs provide tax-free growth and income, making them attractive for conservative investors. Equities generate potential liabilities in capital gains and dividends taxes once annual exemptions are exceeded. Bonds and gilts avoid capital gains tax, but interest received from them is taxable as income. Property investments are usually subject to income taxes on rental earnings. However, strategic tax planning can reduce this burden through tax-efficient vehicles such as ISAs or pensions. Efficient market hypothesis. The efficient markets hypothesis is a foundational investment theory proposing that financial markets rapidly incorporate all available information into asset prices. Consequently, the theory argues that consistently outperforming market returns through active investment strategies, such as stock picking or market timing, is inherently challenging and often impractical. The EMH advocates for passive investment strategies, including diversification across index funds or exchange-traded funds, to achieve sustainable long-term returns, further reinforcing the balanced approach recommended in today's strategy. With the extensive information presented, your investment decisions should align precisely with your individual financial goals, personal circumstances, and comfort with risk. Each portfolio strategy presented today has been constructed to balance expected returns with your acceptable risk levels and liquidity requirements. I recommend careful consideration of your personal and financial circumstances in determining which strategy best aligns with your long-term objectives. With all this information, I hope you can make an informed decision. Thank you very much for your time and attention. I appreciate the opportunity to guide you through these important financial considerations. I warmly welcome any questions you may have or further discussions on any aspect covered in this presentation. Thank you.